Minasan, konnichiwa, Zamurai Engineer desu. Let us take a look on lesson number 2 of this chapter. Apply inventory cost flow methods and discuss their financial effects. So we have inventory is accounted for at cost. Cost includes all expenditures necessary to acquire goods and place them in a condition ready for sale. So those expenses, okay, and unit costs are applied to quantities to compute the total cost of the inventory and the cost of goods sold using the following costing methods. So we have specific identification, then first in, first out, or FIFO, last in, last out, or LIFO, and average cost. These last three assume cost flow. Okay. Example: Krivitz TV company purchases 3 identical 50-inch TVs on different dates at cost of 720, 750, and 800. During the year, Krivitz sold 2 sets at 1,200 each. These facts are summarized below. Purchases: February 3, 1 TV at 720. March 5, 1 TV at 750. May 22, 1 TV at 800. Sales, June 1, 2 TVs for 2,400. So, 1,200 per unit. So, use these facts and we have specific identification. So, this is number 1 method. If Krivitz sold the TVs purchased on February 3 and May 22, then its cost of goods sold is 1,520. So, depending upon you identified all your units, maybe there are serial number. It depends. Okay, so then its cost of goods sold is 1,520, and its ending inventory is 750. Okay, very clear for that method. Actual physical flow costing method in which items still in inventory are specifically costed to arrive at the total cost of the ending inventory. Practice is relatively rare. Most companies make assumptions, cost flow assumptions, about which units will sold. So, specific identification, there is no assumption because you are certain of which goods was sold. Okay? Which one? Which one of the 3? Which one of the 4? Which one among the millions of goods? Okay? But you have what? Sticker with barcode or serial number. Okay? Ethics note: a major disadvantage of the specific identification method is that management may be able to manipulate net income. For example, it can boost net income by selling units purchased at a low cost or reduce net income by selling units purchased at high cost. Okay. So, that is an ethical possible that would happen. Cost flow assumption. Cost flow assumption do not need to be consistent with the physical movement of the goods. Maybe FIFO, LIFO, and average. Okay? So, usually, in this this current situation, usually they are using FIFO, first in, first out. Okay. Cost flow assumption. Example, data for Houston Electronics Astro condensers is shown below. So we have date and explanation. Beginning inventory, purchase, then units available for sale, units in ending inventory, units sold. Okay, so beginning inventory plus purchases minus inventory, ending inventory, that is cost of goods sold. That is what we learned in previous chapter. Cost flow assumption, FIFO. This is general illustration. We have the FIFO method. Cost of earliest good purchased at the first to be recognized in determining cost of goods sold. Often parallels actual physical flow of merchandise. Companies determine the cost of the inventory by taking the unit cost of the most recent purchase and working backward until all units of inventory have been costed. Okay. So FIFO in the inventory and cost of goods sold. So we have purchases and then inventory. Step 1. Step 2, cost of goods sold. You can compute. Okay. Depending upon how many were sold. Okay. We have number of units. Okay. Okay. So if 400 units sold, so we need 400 came from beginning inventory, then those purchased in April 15 and those purchased in August 24. So, but here, if we do it, August 24, 400, all of them. Okay, so that is FIFO. The LISH assumption. Okay, LISH assumption. Another way of thinking about the calculation of FIFO in the inventory is the LISH assumption. Last in, still here. Okay, so first in, first out, last in, still here. LISH. So because that is the newest one, so it's still here. So the oldest stored product already came out. Okay, so this is how you do it when you need 400. Okay, so this is how it works. Okay, how about the third one, LIFO method? Cost of latest goods purchased at the first to be recognized in determining cost of goods sold. So seldom coincides with actual physical flow of merchandise. Exemption include goods stored in piles such as coal or hay. So those who are last in will be first to out, because how can you take out the inside portion of the piles or hay? Okay, so that makes sense. Last in, first out. So how do they do it? So differently. The direction backward. Okay. So this is the illustration how to do this computation. Cost of goods available for sale. Because January 100, and then April 15, 200. Okay. August 24, 150. Okay. So, total 450. So, you can come up with the computation like that. Okay. A very straightforward computation. Very easy for us. But the point is, we are being aware that there is an actual concept, an actual principle that there have been four different methods of this inventory computation. Okay? Fish assumption. Okay? Fish assumption is LIFO, fish. So FIFO is LISH. This is fish. First in, still here. Cost flow assumption, average cost, is the fourth method. It allocates cost of goods available for sale on the basis of weighted average unit cost incurred. So they average the cost for the total. Applies weighted average unit cost to the units on hand to determine cost of the ending inventory. Averaging. Weighted average. Okay. So how they do it? Total the stock, then total the cost, then divide. So we can have that cost per unit and total cost. Okay. Uh, Always the same steps. Step one is determine the ending inventory. Step two, cost of goods sold. Same step. Average cost example. So it's like this ending inventory, then cost per unit. They put all the inventory inside the tank, for example, and they mix up. Okay. So financial statement and tax effects on cost flow methods. Each of the three cost flow methods is acceptable for use. One thing, Reebok International Limited and Wendy's International currently use FIFO method, while Campbell Soap Company, Kroger's, and Walgreens Drugs use LIFO for part of or all of their inventory. Bristol Myers Squibb, Starbucks, and Motorola use the average cost method. And Stanley Black and Decker manufacturing company uses LIFO for domestic inventories and FIFO for foreign inventories. So they use different things. Financial statements and tax effects, income statement effects. Look at the red portion. We have ending inventory. They will become different from each other. So these three are the assumption-based method. So the first one is what? The identify, no? So identification, product identification, particular identification of product. Okay. So we have the net income different threshold. Okay. So the higher the inventory, the higher the net income. Okay. Financial statement and tax effects. Balance sheet effects. A major advantage of the FIFO method is that in a period of inflation, the cost allocated to ending inventory will approximate their current cost. Okay. A major shortcoming of the LIFO method is that in a period of inflation, the cost allocated to ending inventory may be significantly understated in terms of current cost. Okay? Period of inflation. Inflation meaning the the price of materials go higher, no? Inflation. So they have different advantages, no? Okay? LIFO, inventory may be significantly understated in terms of current cost. And the FIFO, inventory will approximate their current cost. Okay? So both inventory and net income are higher when companies use FIFO in a period of inflation. LIFO results in the lowest income tax because of lower income before tax during times of rising prices. LIFO is decreasing the tax. Helpful hint, a tax rule, often referred to as the LIFO conformity rule, requires that if companies use LIFO for tax purposes, they must also use it for financial reporting purposes. Okay? So they have to be uniform. Okay? Inventory costing. Using cost flow methods consistently. Method should be used consistently, enhances comparability, because one accounting period you are using another method, another accounting period you use another method. There's no consistency, and the comparability of the data become suffers. Okay, although consistency is preferred, the company may change its inventory costing method. Okay, Walker Oates notes the financial statement. Okay, effective July 1, company adopted LIFO cost of assumption for valuing majority of uses grocery products inventories. The company believes that the use of LIFO method better matches current cost with the current revenues. The effect of this change on the current year was to decrease net income by $16 billion. And in so doing, they are paying taxes lower, significantly lower. Let us test our knowledge gained on this lesson. The cost flow method that often parallels the actual physical flow of merchandise is A. FIFO, B. LIFO, C. Average cost, D. Gross profit. That is FIFO. In a period of inflation, the cost flow method that results in the lowest income tax is the letter B. Okay? Please take a while, pause the video if you will, and read this article. And after which, please answer this question and put your answer on the comment box section below. What are the arguments for and against the use of LIFO? Okay. So again, this is Dr. EYPEI saying engineering builds a nation.